Welcome everyone, welcome to the Innovation Room, welcome to those of you who came in person this evening as well as many of you out there in virtual land. First I want to welcome you to the New England College of Business. The New England College of Business, just to give you a little background, has actually been around for a little over 100 years. We've had different names, so those of you might know us by the American Institute of Banking. But we've changed a lot over the 100 years, I would hope so, it's been 100 years. We are fully online. As opposed to being a training institute for bankers, we have associates, bachelor's, certificates, and master's degrees. We are focused on adult education. We are focused on career education. And that's one thing that hasn't changed in the 100 years is the linkage between education and workforce. That's something that was with us when we were a banking institute, and that's something that's with us today, except today we're a full-fledged college, so I encourage you to look into us more. The Innovation Room was born out of that unique mission of bringing education and industry together. So monthly, and I hope that you've joined us in the past. I'm happy you're here tonight. I hope you'll join us in the future, but monthly we bring together a group of people to hear some thought expertise on a subject that is relevant to our programs here. Tonight we are so lucky. I can't remember the quote, but someone recently said to me, no one wants to talk about taxes until you have to talk about taxes. So why not have taxes spoken about in a way that's a lot more digestible and where you can ask questions in a safe environment. So tonight we have our wonderful program chair for the Business Administration, International Business Program, here to talk with us about taxes. So without further ado, Donna Viens.
Hello everyone, welcome. So, as Deborah said, taxes is not a subject that we like to talk about, but we get to this time of the year when it's the end of January and you're starting to get all those forms that come in that say important tax information, and everybody goes, uh-oh, I really have to think about taxes. So I'm going to give you some brief updates on what's going on in the tax world. And I'm going to do this in a very easy to understand format so that you can digest it very quickly, take it home with you. There's a few little things that I want to make sure that you understand as we're going through this. Everyone's tax situation is different. So as I'm talking about things tonight, I'm talking about very generalized things, very generalized terms. If you have specific situations, it would be very difficult unless you have a tax professional sitting in front of you to go through that. And even sometimes I have clients who sit in front of me and I have to really digest what they are giving me before I can give them tax advice. That's the right way to do it. So as we're going through this, understand that there are limitations, there are phases, items that phase out during the year. There's items that with your amount of adjusted gross income, they will phase out. So as we're talking about these are general. If you have specific questions about your tax situation, I suggest that you talk to a tax professional. Certainly at the end I will open it up for questions and will answer anything that I can answer, but it should not be taken as tax advice unless I'm sitting in front of you with your information. Okay? As a CPA, I do have to put that little caveat out there that I don't want to give you tax advice in a PowerPoint presentation. So let's take a look at what we have. My very easy to follow information is coming in the form of a 1040. So I'm going to cover the 1040 for you. This is the document that you're going to see. Now a lot of people say, you know, I get these documents in the mail, they're 1040s, and I give them to my tax professional or I throw them away. And I use the online system. Great, online is a good way to do it because then you don't have math errors. But the problem with online is sometimes you don't digest all of the deductions that you could be taking, all of the credits that you could be taking, and all of the income that you should be claiming. So I wanted to give you a really easy way to look at your tax form. And remember, even though you're going to a tax professional, you're signing the bottom of that tax return. So you are responsible for everything that is put on that tax return. A lot of times people say, oh, I went to a tax professional, I don't even have to look at it. You have to look at it because you're responsible. If there's something wrong on there, then you do have to make sure that you correct that with your tax professional. So, talking about the first section of the 1040, we're looking at filing status. This doesn't seem like it would be a very difficult area, but it actually is a place that a lot of people ask questions about. So I'm going to cover just really briefly. The status that you are on December 31st, 2015 is what you are for the entire year. So, if you got married on December 31st at 11:59 and you said those vows and you became married, you're considered married. So you have to make sure that you're taking that into consideration when you're filing your tax return. If you are legally separated, that means you went to court and you filed a document legally separating yourselves, you are considered single. That's the only time that a married person is considered single, is if you have a legal separation. I've had so many people try to do all kinds of things. We've been separated for this many years, where as long as you don't have that legal document, then the IRS is going to look at it and say you're not considered single. There's little things that you can do in there. For example, you can go with an abandoned spouse. There are other items that you can use, but it's not considered single unless you have a divorce or are legally separated. Head of household means you have a qualifying person living with you. I'm going to talk about qualifying person, qualifying child, but you're not head of household if you're just you. So if you're just you and you're single, then you're single. If you have somebody who's living with you, they may qualify you for a head of household. The exception here is if you have a temporary absence. So if you're a parent and your child goes off to college, you can still claim head of household because they are considered temporarily gone. The other item that you might have is if you have a sick child who's in a hospital, or you have a child who's traveling abroad for some educational purpose. There's different items out there why you could still be considered a head of household. So you definitely want to look at those if you're going to consider head of household. Married. You wouldn't think that this is the difficult one, but it really is the difficult one. Oftentimes, and in fact it just happened 2 days ago, somebody will come to me and say, well, I got married this year, but do I really have to claim married? Can't we be single? Don't we get more back being single? No, if you get married during the year, you have to claim married or married filing separate. There's two items there. Now, married filing separate means that you are filing as a single person, but only getting half of the deduction, half of the credit, and there's a lot of complicated information in with married filing separate. It is 99.9% of the time not beneficial to file married filing separate. I have never had a situation in 22 years of doing taxes that married filing separate came out better in totality for the two people. So let's talk about married. Married and living together. Common law, if your state that you live in accepts common law, then you can consider yourself married. That's a very interesting one. Remember, the IRS likes when you claim married versus claiming single because you get less deductions here, because you're making more money, so your adjusted gross income is going to be higher. If you are married and living apart but you're not legally separated, you're still considered married. Now, same-sex marriage. This is a really big topic because a lot of times people say, well, we got married in a state that legally allowed us to get married in 2010, but the IRS didn't recognize it until 2013. Well, I told my clients in 2010, make sure that you write on there, filing single but same-sex marriage in a state that made it legal. We went back and revised all those tax returns because we could do that because we put the preempt in there for the IRS that while they weren't accepting it, the state that we lived in was accepting it. So in Massachusetts, anytime there was a same-sex couple, we put that on their tax return and then we just went back and refiled. Now you don't have to do that because now the way the law is written is if you are married in a state that legally recognizes same-sex marriage, you're considered married. You file exactly the same as you would if it was a male-female, does not matter. The difference here that you need to be aware of is if you're a domestic partnership or a civil union, those don't count. They accept married, but there's not a common law status or a civil union status that the IRS accepts as being a married couple. So I think it's coming. I think it's going to start moving its way towards equality, but right now that's not where we're at. Again, if you are a civil union, I would put that on your tax return as a civil union. What's the worst that can happen? Is they come back and say, well, it doesn't matter, or we're not going to accept that. It's always good to let the IRS know that they're not doing the right thing by not recognizing things. So, exemptions, that's the next part. Now, this is the biggie here. You get a $4,000 personal exemption. Okay, no, they're not giving you $4,000 back. They're just going to take that off of the income that you need before they start to tax you. Your spouse gets one, and every dependent that you have gets one. Now, dependent we're going to talk about in real detail because this is really important to many people. Qualifying child. So qualifying child has to meet the 4 tests, relationship test. So, what does relationship mean? That means your child, your stepchild, your grandchild, your any child that is placed with you by a government agency, so an adopted child, a foster child. If a child is placed for adoption with this statement that that child is being placed for adoption, that's considered your child. If they're placed as a foster child, then you have to weigh who had the more support, so we have to go down to the next step. But it's important that you understand that this could also be siblings and half-siblings. The only problem here, just so you know, is the sibling that you're claiming needs to be younger than the taxpayer. So if I have a sibling and I'm 25 and I'm going to claim my sibling, but my sibling is 27, not going to work, okay? So that's one of those things, actually, those ages are wrong because it has to be, when we get down to this age test, we're going to say, okay, our ages are 19. You can claim them if they're 19, 24 if they're in college. So let's go back. I'm 19 years old and I'm going to claim my 23-year-old sister. Can't happen. Okay, the taxpayer has to be the older of the two. Residency, they have to live with you. So it has to be more than half the year that they're living with you for them to fall into this category. So it's your child in some way, shape, or form. There's an age test, 19 to 24, or permanently disabled, been labeled permanently disabled. You have to have the support, so you have to be providing over half their support. And what they make matters. So if you're putting in $4,000 and they made $4,500, they're supporting themselves. They've put more support into it. And then the joint return test. Now this is a little skippy here when you look at the IRS rules and regulations with regards to this. They can't file a joint return unless they're filing a joint return just to get a refund. So if they're not required to file a joint return, but they're filing one because, you know, my son worked, he made $3,000, he paid in $180, that $180 is going to buy him some car parts, so he's going to go and file that tax return. He doesn't have to, but he's going to file it because he wants that refund. If they're filing a joint return test, if they file a joint return and it meets that test, then you can claim. So that's your child, qualifying child area. Qualifying relative, this is where it gets really different here, okay? And one of the big things with this is they're not a qualifying child, but the relationship is a big thing. So in a relationship with this, it means a member of your household for the entire year, so they live with you the entire year, or, not and, or, big or there, or they are, and I have to give you the list because it's long. They are your child, your stepchild, your grandchild, other descendants of your children or stepchildren or foster children, son-in-law, daughter-in-law, brother, sister, half-brother, half-sister, stepbrother, stepsister. You're getting the picture here, right? Mother-in-law, mother, father. Oh, and if you get divorced, it's still considered your mother-in-law by the IRS, so you could still claim her if, you know. And here's the thing. They don't have to live with you. So they have to live with you the whole year if they don't meet one of those areas. So if they're not somehow related to you through blood, marriage, adoption, foster, something to that matter, but they lived with you. So, you know, let's take a girl, her boyfriend moves in, he's a deadbeat, he's kind of hanging out, not really working, you know, plays Game Boy all day or game system, you know, not doing anything but living with her the whole year. Does it work? Yep. She can claim him as a dependent if he lived with her the whole year. Okay? She shouldn't boot him out the door, but she can claim. Now, same situation, but the guy moves in July, or the guy moves in even in February. No, it does not work because they have to live the whole year. Okay? These other, the next two also have to be met. All of these have to be met, but so far so good. This girl's going to claim this guy as a dependent. At least she's getting something from him, right? So we've met the relationship in some way or another, or lived with them the whole year. Gross income, it cannot make more than $4,000. So same guy, same game station, he's sitting on it and he hasn't made anything. She can still claim him. And support, well, same guy, same game station, but mommy's got a trust fund and she's paying all his bills and she's paying for his Lexus and his car insurance and all of that stuff. Doesn't work. No more can she claim him because even though he lived with her And even though he doesn't have a gross income of more than $4,000, she didn't support him. She didn't provide more than half his support. Okay? So those are important things, and the reason why I bring that up is because a lot of people in our older years, as we start to live in what's considered a sandwich generation, or mine's beyond sandwich generation, as you start to live in this sandwich generation, you have, you're taking care of mom and dad, you have your children and sometimes their children. Mom and dad don't make a whole lot of money, so you're sitting there and you're paying forward to mom and dad. Maybe they live in a house that you own. Maybe you pay for their car insurances or pay for enough of their support for it to be considered half of their support. You can claim mom and dad even though they don't live with you. Okay? You have that right to claim them. Same thing goes for anyone who is a relative, blood, in-law, that type of relative. As long as you can get them through the relationship test, they don't make more than the $4,000, and you're supporting them over half, you can claim them. So that's an area that a lot of people don't realize, and when it comes to our elderly parents, as we're starting to pay for more and more of their care, as they're happily living longer, we want to make sure that if you are paying for it, you are able to claim them. So I spent a long time on that, but that is a really big area that people miss out on a lot. So let's talk about income. Everything that comes on a W-2, a 1099 from all sources, 1099-G, this is everybody's fun one. I always love this one. Your refund that you got last year from your taxes, your state refund, that's taxable this year, okay? The only time it is not taxable is if you did not itemize last year. So if you just take the standard deduction, it's not taxable. But otherwise, if you itemize, you are saying to the government, when we see the itemized deduction, I'm going to show it to you, you're saying to the government, I want a deduction for that. I want you to take off of my income what I paid for state taxes. Well, if you take $5,000 and you say, well, I paid in $5,000, but the state gives you back $2,000, you've got to claim that too as income because you took it as a deduction the year before. Okay? So that's a big one. Most of my clients, probably 90% of them, forget to bring that piece of paper. Fortunately, if I filed it last year, I know what it is, so I just roll it into it. But that's one of the big ones because as soon as the IRS, that's one of the connections that happens right away. You file your tax return, they know what it's supposed to say. If it doesn't have that on there, you're getting the, hey, you didn't file something. Your income's different. We need to pay this. Unemployment. I put two 1099-Gs here because they come on two separate forms. 1099-G from your state tax is going to come from one form. Your 1099-G from unemployment would come from another form, okay? Though it's really important, yes, unemployment is taxable. I know it seems like, you're kicking somebody when they're down, but it is a taxable amount. And you want to make sure that you put that on because, once again, they know that information. That's in their system loaded and ready to go when you file your tax return. Social Security benefits. If you are a retired person and you have just your Social Security benefits, probably not going to be taxable. You're probably going to be okay. Run it through the first year, make sure if nothing changes, then you're pretty much done filing taxes because you're not paying anything in and you're not going to get anything back. However, if you have interest or dividends or a small job or a small business or anything else going on, you want to run those numbers every year because up to 80% could be taxable. What happened? Oh, here it is. Okay. Kind of dysfunctional when it comes to PowerPoint sometimes. Other income. You do not want to go to jail for tax fraud, okay? If you don't get a 1099, but you know for a fact that you were at Mohegan Sun and you won $5,000, but you didn't get any tax form or anything, you gave them the wrong address or something. They're going to figure it out, okay? You want to jump in here and put all your income. And the thing with gambling winnings is you can only deduct gambling winnings against gambling losses if you claim gambling winnings when you first file your tax return. So if I file this tax return and do not put my gambling winnings in here, and I can't take them as a deduction if I don't put them in here, but then the IRS says, hey, we know you won that $5,000. You cannot turn around and then say, but I spent $2,000 in scratch tickets. You lied once, you don't get that back. So make sure that gambling winnings, and it's funny because every year I seem to have somebody who forgets to tell me about their gambling winnings, or we live in a state where gambling is all around us. They'll just forget. Or they don't want their husband to know because they went and bought really nice shoes with that money or something like that. It always comes back. It always comes back. So you want to make sure that you're including all income here, okay? Non-income, so sick pay. Rhode Island happens to have TDI. Accidental and sickness insurance, anything like that is not going to be considered income. I call it non-income because you're probably not going to get something that says you got this money, but you're going to come to me or your tax preparer, or you're going to sit at your computer and do it, and you're going to go, but I got that money. And she said everything's taxable, so let me jump that in there in that other income and raise my income way up. No. Inheritance, workers' comp, those types of things are not going to be considered. If you're in doubt, definitely ask the question. If you're afraid that, okay, this might be taxable, for example, you got into a car accident, all your pain and suffering is an additional amount on top of what you get for medical expenses, depending upon whether it's punitive or not is going to depend on whether it's going to be taxable. You want to make sure that you're checking that out. Most of the time you're going to get a 1099 for it, but don't always count on everybody else to mail you out that, especially if you've moved during the year or you have a different address on your license or something like that. You want to make sure that you're taking a really good look at that so that you don't end up having the IRS come back and say, hey, you didn't claim this money. So that's what I call non-income. When you're looking at these, a lot of times what I tell people to do, and I have just a little sheet that has almost the whole 1040 on it, and I just go, okay, did you have dividends? Did you have taxable income? Taxable interest? Did you have alimony? Okay, if you received alimony, not child support. Child support is not taxable, but alimony is. Alimony is taxable to the person receiving it, and it is a tax deduction for the person who paid it. So those types of things, you want to make sure that you're keeping a really good look at what you received during the year. You'd be amazed how much people forget what money came in during the year until you start asking these questions. So I call this the above the line. So the whole thing is when you look at adjusted gross income makes a lot of decisions for you. Adjusted gross income is going to tell us how much deduction you take in, how many credits you're able to take. Lots of the items that you're going to look at after this line are based on what that adjusted gross income number is. So if you can take educator expenses, that means that you teach from grade 12 and below to kindergarten, you can take $250 there. If you have a health savings account, you have moving expenses. Moving expenses are a really specific thing. Make sure you're moving within the range that they allow, which is 50 miles. The job is within a certain mileage. Make sure that you're looking at those things if you're going to go there, because that is definitely a very specific one. Self-employment, if you have a SEP or a simple plan or qualified plans. Again, here's your alimony payment, IRA deductions, student loan interest. I picked that one out because we're in the education facility, so let's talk about that. Student loan interest is a big one. So what happens is when you are taking out those loans, you're taking them out in those your tuition and fees. You're able to take your deductions based on the amount of money that you're taking in loans. But you also get to take those interests. So that interest that you're paying as you're paying those loans off, you do get to take. It is limited. Again, we have some limitations that go on here with income, but that is a deduction you should look at. One thing that I realized last year is they no longer send statements out. They used to send a statement out that said, hey, you paid this amount in interest. They don't necessarily do that anymore. So if you know that you're paying that student loan every month and it has to have some interest to it, go online and take a look at it. Usually your tax preparer does not need the statement. They just need to know what the dollar amount is. So print out that page that says this is how much you paid in interest in that time period. So student loan interest up to $2,500 per year. Again, it does limit as you get up there in income, so you do have to watch that. Tuition and fees, you're likely going to get a 1098-T. Now, we're going to talk a lot about tuition and fees in the next couple of slides because it's actually found on the 1040 in 3 different places, because that makes it perfectly simple to remember where you're putting it. You cannot take the deduction in all 3 places. So you have to make sure that you're taking the best deduction for you? Is it a deduction? Is it a credit? What is going to work best for me? And we're going to talk about that. This is a question I do get quite often is, I paid for my child to go to private school. I paid for them to go to private high school. It's $10,000 a year. I want to deduct that as tuition. Nope. College is the only thing that is deductible. Trade school is deductible as long as the student is out of high school. I sent my student to a VOTEC school. Nope. If it's a VOTEC high school and what they end up with at the end of it is a high school diploma, which you hope they end up with a high school diploma after that, at that point it's not considered tuition and fees. Okay. So everyone who files a tax return who is not being claimed by somebody else gets a deduction. So if you are single, it's $6,500. If you're married filing joint, you get $12,600. Married filing separate, notice how they cut you in half there. Now the big thing with this is where all my little stars come in. Big thing with married filing separate is if you claim the standard deduction, your spouse has to claim the standard deduction. If you claim an itemized deduction, your spouse has to claim the itemized deduction. So let's say you said, let's married filing separate, you take the house and all of that stuff, you itemize, I'll just take the standard deduction of $6,300 and we'll be great. Nope, doesn't work that way. Married filing separate, the first thing the IRS is going to do is connect your two Social Security numbers and go, nope. You both get knocked down to either itemized or standard dependent upon who filed first. It's actually the way it goes. Head of household is $9,250. If you're blind or over 65, there is an additional deduction that's allowed. So those are items that you want to make sure you know. For the blind and over 65, if you're single or you're head of household, it's $1,550. If you're married filing jointly, it's $1,250. Why is there a difference to $1,250? Because it's for each person. So each person gets that $1,250. Okay. So itemized deductions. So let's say you say, okay, listen, I think I should be able to get more deduction than just that one amount. The first question you need to ask yourself is, do you own a home? If you own a home, likely we're coming on this page. Now there are some people who have owned their home for years and years and years, and they've paid down their mortgage, and they only have a little tiny bit of interest going on there that would not need to file this. But likely if you own a home and you're paying real estate tax, a lot of real estate tax goes over that already. So bring it over to the itemized deduction form and fill it out. The worst that can happen is you come down to the bottom and you go, nope, gonna take the standard deduction, but it's worth trying it. Now again, years and years ago when all of this was done by hand, that would have been very tedious. Now if you're doing it on a computer program, it's going to ask you the questions and make the decision. If you go into a tax preparer, they're going to pretty much be able to take 5 seconds, look at what you're handing them and say, yeah, you're going to itemize, no problem. So we have our mortgage interest and our real estate. Once we get that, we want to start looking at some of the other stuff. Medical expenses. Now this does not count medical expenses that's taken out by your employer, that's paid in a medical insurance type of manner through an employer. This is more talking about your co-pays to doctors, your prescriptions. If you have, your child has braces put on. Now I am a tax person. I've been a tax person for a long time. My son had braces put on, and the year that he had braces put on, I had to amend my tax return because I forgot he had braces put on. And they were like $6,000, and I forgot he had braces put on. I couldn't believe I did that. And I looked at it and went, yeah, that really wasn't a smart one to do. So with this, what's going to happen, though, is you're going to take that adjusted gross income. Remember, I told you that's a really important number. And it's 7.5% of your adjusted gross income. You're going to come up with that number. Whatever's above that in medical expenses, then you can deduct it. But it has some limitations here. And they have all their fancy little terms as you're going through there. Delete, deduct this and add this to this, and which one is bigger, and it's the IRS's way of doing it. So you definitely want to take a look at that if you have some medical expenses. Here's where you put in your state tax. Remember I told you you're going to put your state tax as a deduction? So if you itemize your state tax, what that means is that you're going to have to take whatever your state refund is, and you're going to have to put that on your tax return the following year. So you're going to put your state tax in here. Personal property tax, that's our excise tax, so that's your car. That's usually the one I have to chase people for all the time. If you have a car and you're paying excise tax, personal property tax based on the vehicle's value, which is what Massachusetts, Rhode Island pays. If you're watching this from someplace else, take a look to see what the value, what the excise tax is based on. This is where you're going to put that number. So if you have 2 vehicles, you're paying $300 each vehicle for excise tax a year, add that in there, okay? And that's usually about average, is the $300, especially for newer cars, it could be even more. Other taxes. This is where if you're a Rhode Island person and you're paying Rhode Island TDI, you actually get to put that up here on your itemized deduction. And the reason for that is because TDI is not considered something that you have an option to pay. You are required to pay it. You have no other choice. It's a benefit you get if you do go out of work, but because in 2011, I'm guessing there, it's 2010, 2011, that tax year, they made the decision that Rhode Island tax, TDI, would be able to be deducted here, and then they let you go back and file the years that, for 3 years. So that's something that you do want to include here under other taxes. Most of the time that's not going to flow from anywhere. You're going to have to put that in. So next thing, we go down to our interest. So I talked about the interest paid on a house. That's where you're going to put that. You're going to put your insurance premiums, points paid. One of the big things here is if you are somebody who just bought your house or just refinanced your house, that settlement sheet that goes from the seller's amount and the buyer's amount, there are a lot of key items in there that you can deduct. So if you did buy a house, my suggestion, I'm a tax preparer, so I'm going to tell you this on numerous occasions, but my suggestion is if you change your status in some way, shape, or form during the year, talk to a professional, because they're going to be the ones that are going to be able to tell you, even if it's just for that year, and then you can copy it the following year, you want to make sure that you're making those changes. Gifts to charity. This is a place that I usually tell people, be very careful. Giving, the guy on the side of the road $5 or $20 is not tax deductible. It has to be to a tax accepting 503C or one of the places that is going to give you a receipt. I always say they're going to give you a receipt if you are going to give them money, okay? Or you're going to have some type of receipt for that. You can give to Salvation Army, Big Brothers, Big Sisters, those type of things. They'll give you a receipt, which they'll usually give you a blank receipt. You need to fill out what you gave away. It's your responsibility to tell the IRS, because if the IRS comes knocking and says, yeah, you took $5,000 worth of Big Brother, Big Sister donations, prove it. They're going to want to see what you came up with, and they're also going to want to know how you valued it. So if you give away a $1,000 suit, you can't say, I'm giving away a $1,000 suit, so I get to deduct $1,000. You're going to have to take thrift store value or consignment shop value. So you have to look at those things. That's really important when you are. This is always the place I tell people, keep your receipts. Whether it's an email saying thank you, whether it's something that came in the mail, keep your receipts there. Keep them for the entire length of the time that you have your tax return. That means you should be keeping it 3 years at the minimum. 7 years is ideal. Or you could be like me and keep them forever. You want to keep your returns, because if the IRS comes in 3 years and they say, oh, I found something, I want to go back 3 more. Oh, I found something, I want to go back 3 more. They can keep doing that. They can go back till the point where you filed your first tax return. Not that they're going to waste their money unless you're committing some type of major fraud, but you want to make sure that you're keeping your tax returns on this. And with the charity, keep those receipts in there, because those are going to be important. If a charity happens to get called on their tax exempt status, that may be something they send out a letter and say, how much did you really give to this organization? So I had a client a couple years ago who had that happen and had to tell them they had given like $4,000 to this charity, and they had to prove that they had a letter saying that they had given that amount of money. I don't know what happened after that, because I wasn't part of what the IRS was doing, but it certainly can happen. So keep this information. That's a really important place. The other thing I always say is, if you are going to fill this out and it's more than $250, and I would do it if it's $5, but make the list on one of the statement sheets and send that into the IRS. It can never hurt to tell them more information than they want to know. because they will definitely look at that. So if you have some casualty loss, I'm not going to go into that because it's a really specific area, but definitely look into the rules there. And then you have your 2% items. So anything that's adjusted gross income, you're going to take 2%, and then everything above that you can take. This is where your job expenses are. This is where you took a seminar class, or you paid dues, or you're in the union and you're paying union dues. You're doing something, tax preparer fees. Definitely take your tax preparer fees here. Anything that is going to be for your job, that is considered to better yourself, but does not hit the education and does not hit an employer expense that you're able to get reimbursed for, or you're able to go further into the filling out the different forms, because you have some forms, they're EZ forms or they're full forms on some of the expenses that you do pay for your employer. Like, for example, if you're traveling a lot for your employer, you'd want to fill out the full form. So just be careful when you go into job expenses. A lot of people go, it's not even worth it. It may not be, depending upon what your adjusted gross income is, or you may have enough expense where you say, yeah, you know, I pay a lot of dues, I pay a lot of seminars, I pay a lot of union dues, or whatever it happens to be, expenses that have to do with, for example, if you work in a place where you have to have steel-toe boots, you can deduct the steel-toe boots. Okay? You cannot deduct dry cleaning. Everybody wants to deduct dry cleaning. You can't deduct dry cleaning. I get it. You can't deduct your outfits. You know, I can't deduct this because I dressed up all nice for you guys today. I can't deduct it because I can wear this out to a place. If I have, however, a shirt that is a company logo shirt that I had to buy, or if I'm in a position where nothing that I wear can be worn in the outside world. For example, if you work for an asbestos removal company, I really don't want you coming home with asbestos all over you, so you're going to need to leave that someplace else. That's something different. So there's some limitations there, but even then you can't deduct the dry cleaning of the asbestos suit. Okay? Other miscellaneous deductions, this is usually where you're going to put, you know, some gambling items in there. If you have gambling winnings, you want to get gambling losses. Guarantee you that red flag goes up the minute you put anything on that line item, so you've got to be able to support it. Okay, it is every year that I've ever done taxes where I've been able to tell what the red flags are going to be, that line is always a red flag. So if you're going to put something on the line, make sure that you can back it up. Now, I'm not saying that you have to back it up with your scratch tickets. You don't have to save every single scratch ticket. But if the IRS comes knocking and you can't prove that you had that much in losses, that's going to be a problem. How do you prove it? A lot of the, I'm not a casino person, but I do know that a lot of them have those cards that you put in. It actually keeps track of how much you're winning, how much you're losing. You can get a printout that shows how much you lost. Okay. So now you come up with your total itemized deductions. Again, this is going to be someplace that you have some limitations, but for the most part, you're coming up with your itemized deductions. As long as that's more than your standard deduction, that's what you want to put on your tax return. So let's go on to the next part of the tax return. So we have our adjusted gross income. Now that's a number that we know from the first sheet. We have what our itemized deductions are going to be, or our standard deductions. Now we're going to just put it all together here, and we're going to come up with some numbers. Now here's the biggest thing that you need to know. Everybody kind of uses credits and deductions together. No, totally different items. A deduction is something that reduces your taxable income. Great, that's awesome. It reduces your taxable liability. Nice, really great. But a credit is something that is going to eliminate your tax liability, dollar for dollar. Okay? So when you come up with a credit and you say, okay, this credit is $1,000, it's reducing my tax liability by $1,000. Now here's the only exception. There are some credits that are what they call not refundable. That means that after you've reduced your tax liability down to zero, you don't get that money back. Okay? Most of the credits are set up that way. Some of them have little items that are not. Okay? EIC, Earned Income Credit, happens to be one of the big ones. Earned Income Credit is a refundable credit. So let's talk about some of these credits that you're going to be looking at. So we have the child independent care expense. So you're going to fill out a form 2441. You get $3,000 for one child. You get $6,000 for two or more. So if you have 10 kids, you only get $6,000. Okay, I don't know. I guess they think it doesn't cost anything after the second child. They're wrong, but let's just go with that. Education credits. This is really important. Remember I told you a few slides ago that tuition and fees, we wanted to watch that number. We did not want to just plug that number right into that form. We want to really take a look at this because with education credits, you need to remember you can't double dip. Okay, you can only take it in one place. So you can take your tuition and fees, you can take the American Opportunity or the Lifetime Learning, but you can't take all three. And you can't use the same amount of money. So say I paid $12,000 to go to school, I can't put that in all three places or consider it in all three places. And yes, people do want to do that. You can't do that. I'm going to talk a little bit about the American Opportunity Credit. Again, remember I told you that it's in 3 different places. So you've already seen the tuition and fees in one place. Now you're seeing the Lifetime Learning Credit, which is going to be here with our tax credits. And then you're going to see the American Opportunity Credit when we get to line 68. So be very, this is where people usually go, okay, I'm done. Here, take this because I've had enough. Because you get to take whichever one is the most, has the most advantage to you, but you need to calculate all 3 of them to figure out what that is. And those forms have lots of add this and what's smaller, and, subtract this from that. So let's go over here. We have the child tax credit. So you get $1,000 per child. This is usually a really, really fun conversation with people who come in and they have 17-year-olds. You get it for children under 17, not 17. Because for some reason the government thinks that when they turn 17, they're not as expensive. Okay, let's go with that. So if your child turns 17 as of December 31st, 2015, you cannot take this child tax credit. And the IRS can add, they do know what their birthday is, and if you file it electronically, it tells you right there that they're 17. You can't take that. You don't get that $1,000. Other credits, I just want to point out here, this is one of the big credits that I have a group of people that I work with or deal with on Facebook who work with adoptions and foster care. And I have a lot of clients that are in that situation where they have foster children or they're going through adoptions. The adoption credit is a really great credit that is being offered. It's $13,400 per child, so it's a good credit to have, but you need to be able to sustain that you've had that expense and that you've paid it all yourself. So if you have a child who's been placed with you for adoption, and you're spending that money for that adoption, once the adoption is final, you can deduct that. Now, notice I said once the adoption is final. So if in 2015 I'm still going through the process and then in 2016 it gets finalized, I can take the 2015 and the 2016 expenses in 2016. Okay? If a child is placed in foster care, you can take the money that you're spending, whether you're going to put them as a qualified relative or a qualified child, but the money that you're spending on your court fees and things to that matter do not get included here. Okay? So going on to our next part. Remember, we're still on our 1040. I know it's getting old here, but we want to make sure we covered the whole thing because there's so many things here. When you get to this one, we're talking about earned income credit. Remember I said that that's refundable. Okay? That's based on the number of children that you have. It changes every year. It is one of the biggest red flags that the IRS has because more people have defrauded the government based on EIC credit than any other credit known to man. Why? Because it is a refundable credit. So when I say refundable credit, what I'm talking about is if you have one child and you basically made very little money, paid very little tax, let's say you paid $500 in taxes, you can still get that $500 back plus you can get $3,359. Again, they change every year, so I want to make sure I get that right. That's for one child. Okay? If you have 3 or more children, you can get $6,242 back. So you can see why people would file erroneously. There are numerous forms that have to be filled out when you're taking the EIC credit. It's not only verifying your income, it's verifying that you have the child in your presence, that you were able to support the child. So there's a lot that goes on with that. Again, this is an area, if you're going to file with an earned income credit, my advice is have a tax professional sign that tax return so that you know for sure that you're not going to run into a problem. So you have additional child tax credit. Here's your American Opportunity Credit. So line 68, it's $2,500 per student max. Now remember what I said with the lifetime learning credit, it's per return. This is per student, okay? So per student can take this, but you need to make sure that you're looking at all of your options. And then there's miscellaneous credits, and if you fall into one of these categories, you're going to have lots more forms to fill out, so I'm not even going to go there, but if you do find something that comes up, every year they're different. You know, sometimes it's renewable energy, sometimes it's whatever happens to be on Congress's to-do list during that year, they'll put in a miscellaneous credit. So just keep in mind that those are available. This year, as well as previous years, you can have your refund direct deposited into your bank account. Awesome. 7 to 10 days, if you file early in the season, you can get your money put into your bank account from the Fed. Sometimes states take a little bit longer, especially if you're filing more than one state. But this is a really good way that there's no theft involved. Okay. Another thing I just want to mention here is there's been a lot of talk about these new numbers that the IRS is sending out to people because they're afraid of fraud. Doesn't mean that your life has been compromised if you get one of these from the IRS. Okay. It's an identification number that the IRS is saying something didn't look right. Maybe somebody typed in the wrong number when they were filing a tax return. Even if they didn't fully file it, something came up. Or something was on an IRS computer that was compromised, on a state computer that was compromised. Could be, I know a lot of people received notices through some of the exchange type of tax places, and those were compromised. So if you've ever gone to, I'm not going to name one of them, but one of the, the Lady with the Liberty or the Green Place, if you've gone there and you received a letter, they may have been compromised, which would send you one of these IP numbers. So if you get an IP number, it's not a big deal. Just make sure you give that to the person preparing your taxes, because if not, it's going to get rejected every single time. And people, if you think that you have been compromised in any way, shape, or form, or you think that somebody is going to compromise you in any way, shape, or form, you're getting divorced, something like that, you can always talk to the IRS and say, I really would like an IP number, because I think that somebody's going to fraudulently file a tax return, and they don't mind. This happens a lot with children, especially children that are in foster care or going through adoption series. You can file for an IP number so that nobody can electronically file for that child. Okay. So Affordable Care Act, I know this is where everybody goes, oh no. All right, here's the gist behind Affordable Care Act. If you have received health care through the marketplace, you're going to fill out the top part of this. So you notice this is, we're back to splitting the tax return here. So you're going to fill out the top part of this where you're going to put in the premium tax credit. That's line 46. You're going to complete a form that's specific to this. But you'll receive a 1095A. If you received health insurance through the marketplace, you'll get a 1095A. That's what you need to fill this out. Okay? And that's going to give you a credit for overpayment. If you overpaid, it's going to give you a credit for your payment into your health insurance. That's a good one. Now we come down here, and we need to look a little bit more at the individual responsibility. This is what everybody is talking about. This is what the news cycles keep going through. If you receive a 1095B or a 1095C telling you that you have full coverage, you're good. You come over here, you go full coverage, check, move on to the next line, you're all set. Nothing calculates, nothing to fill out, you have full coverage. Just remember, the IRS is smart, and they're using supercomputers that are bringing all this information together. And it may take them a year or two to figure it out, but they'll figure out that you didn't have insurance if you don't fill this out. So what happens if you have no health insurance at all? You're like, nope, don't have any health insurance at all. There are some stipulations that you can get away with not having health insurance. For example, if it's against your religion, and you'd have to prove that. If you are from an Indian tribe, there's numerous ones. Take a look at that if you think that you qualify there. But for most people who don't have health insurance, you're going to need to fill out an 8965 and determine the penalty. This is the news cycle. So you don't have enough money to pay for health insurance, but you have to pay a penalty to the IRS. Big, big, big news here is this gets paid directly to the IRS. This is on your tax return. So if you have money coming back to you in a refund, it's going to deduct from that refund. If you owe the government, you're going to pay more to the government because of that penalty. You're not going to pay your tax preparer. Okay? This has been, they have $500,000 that the government is right now saying that tax preparers were, they're not really saying tax preparers, they're saying people who filed their taxes have received from clients because clients say, what do you mean I owe this money? Yeah, you have to pay that to me right now. Never. When in doubt, never, 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 never do that. So you're going to pay that directly or it's going to be deducted from your refund. So Affordable Care Act is a big one. There's a lot of changes going on here. There's a lot of information going on here. It really has a lot of stipulations to it, and there are so many little curve holes in this idea of Affordable Care Act. But it is really important that you know if you did not receive a 1095A or a 1095B or C because you did not have insurance, you're going to need to calculate this penalty. Is everyone going to pay a penalty? No. The IRS does have, well, they have some harm. If you're under the poverty level and you just don't make enough, then they're going to come back and they're going to say, okay, you don't, it's zero. But for everybody else, you're going to have to go through the calculation process to see what you owe. So, April 15th is tax day. Not this year. This year, taxes are due April 18th. Okay, Emancipation Day is on the 16th, so they put it forward to the 18th. So you people who like to prolong until the absolute possible last minute, there you go. Extensions. You can extend your filing until October 15th. Okay, you can put in a 6-month extension. Just remember that if you owe money to the government, they're still putting taxes. They're still putting the interest and penalties on that because you don't get to extend your payment. So you have to pay them. I know that doesn't make sense to a lot of people, but you have to pay them even if you don't file the tax return, or you're going to pay those penalties. If you don't owe any taxes, you actually have 3 years to file a tax return. So let's say, for example, you didn't make a lot of money, you have $200 that you paid into taxes, and you're like, I'm not going to pay somebody right now to do this, or I don't have the time to do this, or I'm just not interested in doing it. You have 3 years to file that so that you get your money back from the IRS. Just I will give you a really friendly warning here. If you file a tax return that is 3 years old, you can guarantee it's going to take you 6 to 8 months to get that money back. It doesn't matter if it's $5 because the IRS is going to say, well, you waited, so we can wait. We're not going to worry about it. So, last thing, really important. If you saw my last presentation, it was about get yourself in line on January 1st. Come on, get in line for filing your financial aid forms. Make sure that you're sitting there. Now, some of you, I know, because you listened and you were awesome, and you got yourself in line on January 1st, and you're like me, you're typing away and getting all that information in there, and you're ready to go. Well, if you're ready to go, you're going to come back to your page. You're going to pull up this page right here. This was from 2013. Sorry about that, but 2013, same thing as 2015. You're going to come over here. You're going to put your PIN in. You're going to link to the IRS. It's going to upload all your information. You're going to send, and you're done. That's it. If you didn't listen, okay, still not too late. We're still in January. Okay, we're still good. You can still get yourself in line. Go into your form, fill out your paperwork. When you get to this page, do the same thing. The only thing I have to tell you about that is if you file by paper, which I don't know why you would do that because the IRS does not like that. If you file by paper, it's going to take probably 8 to 10 weeks before the IRS uploads your information because they have to type it all in. If you file electronically, you want to wait 2 weeks at the minimum. I usually say 2 to 3 weeks because that gives them enough time to have accepted your return and put it through. Although I will tell you that I tend to be very impatient with my clients' returns when it comes to doing this. So usually I file the tax return, it gets accepted by the IRS, and a week later I go and upload this stuff, and it usually works out for me unless there's been a problem with the tax return. So you can do it, but make sure that you don't forget to do it because the financial aid is only going to hold for you in line for a certain amount of time.
Sorry to interrupt, but somebody just said they got an email from FAFSA stating they are getting rid of the PIN number.
Getting rid of the PIN number.
I have no idea.
All right. I don't think that I've seen that yet. I know I got an email from FAFSA saying that it was time to file for like 100 people, but I don't think that I've seen anything about the PIN number. I will definitely look at that though and see what I can come up with. All right. And that is about the extent of it. Of course, I'm going to take questions. I'm sorry I went on a little bit longer than I had planned on, but hopefully I gave you enough information where you're feeling pretty confident in at least the 1040. When in doubt, don't go it alone. I always say this about, taxes, is you're not going to operate on your brain by yourself. You really shouldn't be cutting your hair by yourself. You're not going to stitch up your boo-boo or if you have something, okay? Taxes are meant to not be easy. They keep us in business, but it's also, every time a new law comes out, there's new situations, there's new restrictions, there's new phase-outs, there's new things. Don't go it alone, especially if you're having a situation that's changing. And if you are going to go with a professional, go with a professional, okay? You're better to do it yourself than go with somebody who has no experience, so go with a real, live professional who's going to be able to support you in front of the IRS if they make a mistake. And that's another big thing, is if you're going out on a limb on any tax situation, make sure that the person signing that has a CPA or an A after their name, because if they don't, they cannot go in front of the IRS as your representative. And believe me, you do not want to be talking to the IRS if you did not prepare that tax return. Okay? So questions?
I have 2 questions already in the chat. The first is, just in general, when do you think it would be appropriate to seek advice from a tax professional as opposed to simply using H&R Block, for example?
Okay, the green place is never a good thing to do. Tax professional, again, it's really based on your situation. If you are one W-2, you don't own a house, you maybe have a child or you don't have a child, you can go on, buy one of those programs, put it in. I mean, the IRS actually offers places where you can go and do your federal return for free and just pay for your state. So those are fine. It's when things start getting complicated. Houses, when you buy a house, when you're 4 or 5 W-2s, or you have a business, or you're somebody who has children in and out of your house, maybe some in college, you want to take a look at that because you want to be able to get the most money. Normally, people who file their own tax return, and this is just only in my 20 years experience, normally people that file their own tax return bring me their tax return and I find something that they missed, because I went to school for this for a really long time.
The next question is, what qualifications do you recommend we look for when we're seeking a tax professional?
Big thing is CPA. CPA or an EA. An EA is an enrolled agent with the IRS, so they have the credentials. You can go to somebody who has a lot of years of experience. That's great as well, but remember that who can represent you in front of the IRS and who can take those tax stances. The other thing is, not every CPA is the same. So, for example, if somebody comes to me and they're in a profession that I don't really handle, and it's not really my area of expertise, I will likely hand them off to somebody who I'm friends with, one of my tax professional friends. Same thing happens to me. I happen to specialize in the construction industry and lower income adoptions, foster children. I do a lot of not-for-profits, those type of things. I would take those versus one of my friends might call and say, hey, Donna, I have somebody who has this going on. You have to ask what they have. Everybody's not created equal, and that's something that I've seen a lot of, is somebody will come to me and say, oh, yeah, well, I own a business and I went to so-and-so, and I don't think they do businesses, though. No, they don't. They do 1040s, and that's great, but when you have a business, you have more going on. So check the credentials, but always check what their experience is.
We have another one. What is your feeling about TurboTax, the program?
If you have little information, you can walk yourself through a TurboTax. The problem that you have is when you start to get into those more difficult questions. They're not made for the difficult things, but they're certainly made for that everyday person who has a W-2, a couple of things. If you have a business, do not do TurboTax. If you have a house that you just bought and you want to see what you're supposed to be taking, go to a professional, even, like I said, even if it's the first year.
I have no more questions in the chat. What about the room?
I just want a clarification on the $4,000 personal exemption versus, my screen just went blank. The single standard deduction, 65. I think I typically file as a single and do the 6,500 deduction, but I guess I got confused with how that's different than the 4,000 personal exemption. Maybe I'm just not.
No, that's actually a great question. You actually get both.
Okay.
So you get $4,000 for claiming yourself. Now, if you're like an 18-year-old and your mother's claiming you, she gets that. You're not. You're claiming your $4,000. That's for just being you, just because. The standard deduction is what you get for saying, okay, this is the amount of income, but the IRS is saying, well, $6,500, we're just going to take that right off the top. You didn't make that. We're not going to tax you on it. You're all set with that. So you get both of them.
Okay.
So the two of those added together is really what it comes out to when you say, do I need to file a tax return or not? So if I have to file a tax return, it's because it's over that amount of the two of them together.
Okay.
So you do get both of them, and that comes off of your income. No problem.
What about on the Affordable Care Act, the 10, whatever it was, the B and the C form? So if you have paid insurance for part of the year, I assume there's a calculation, so you get credit for part of the year, whatever you did pay.
You do.
Okay.
Now, a B and a C, the only difference between a B and a C is a B is when your employer is paying the health care and they're paying it through one of the normal healthcare companies. The C is when it is employer paid, so some of the bigger employers will pay their insurance or they self-insure. That's the difference between a B and a C. That's the only difference. It's an IRS tracking measure to make sure that they're properly reporting it, but it's not going to affect you differently. Now, if you have insurance half the year and you do the calculation, it'll say how much was paid by an employer, how much was paid by you, and you'll come up with a calculation for a penalty.
Just another chat question. My grandmother is 95 years old. Is it necessary to file a return for her?
If she's only getting Social Security, no.
She'll be dead by the time they catch up with her, right?
If she has interest in dividends and other income that's coming in, then yes, she would definitely have to look at it to see whether or not she goes over that exemption amount plus her standard deduction. The better question is, can you claim her? Mm-hmm. So take a look and see how much are you supporting grandma, and can you possibly claim her? If she's only getting Social Security income and you are supporting her enough to be half her support, then absolutely put her on your tax return. And again, she doesn't have to live with you. Anybody else?
As long as you don't owe, it's okay not to file. Even if you make a lot, let's say you're just one of those people who they take a lot out and you know you have a lot in deductions. As long as you know, say your situation hasn't changed in 4 or 5 years, that you're not going to owe. If you're willing to let that $200 maybe that you're going to get back go, you don't have to file, right?
No. That's actually another one of those places where people make that mistake. The IRS does not know what your deductions is, nor are they going to calculate your deductions or your credits for you.
Okay.
If you make money and you make over $10,700, you are going to want to make sure that you're filing a tax return, even if it is for no return back. I file 0 returns all the time. That's great money management because you're not giving the money to the IRS to hold for tax-free or for interest-free, but you definitely want to file it so that you can offset that income with deductions.
My last question would be in relation to calculating the support for a parent. How do you come up with that figure?
So there's a really good form on the IRS website about support, but what I would do is I would take a look at what does it take for that person to live. So their housing, their food, car payments, insurance, take it all into consideration, and then how much are you putting forward towards them. If you're putting forward half, that's great. If you're not, and remember, it's got to be half of the support. So if all of that comes out and they're paying $4,500 of it, but you're paying $7,000 of it, then you're paying over half, so you can certainly deduct it. If there's a tie, so if you're both paying $4,500, then there's actually what's considered a multiple support agreement or an agreement to claim, so you can claim them still. But just be cautious when you're using that type of situation, because the IRS may come back and say, well, wait, are you sure you can claim them? That's the other situation when you have a child in your house for a part of the time, as like a foster child. Somebody gets the deduction. Somebody always can take the deduction and the exemption. You just have to determine who has the most right to.
I have 3 education-related questions.
Okay.
I'm the head of a household and attending school. My daughter started college last year. Will I be able to receive life education credit and the American education credit?
2 different students. So yes, she'll be able to, for her, the lifelong credit will be able to be taken, and then not the American opportunity, but the tuition and fees. So you can't take the 2 credits. You can take the fees and you can take the lifetime learning.
All right, the next question is, can you deduct college expenses for a child you do not support and does not live in your home?
Does not live in your home and you do not support is based on whether or not you can claim them as an exemption. If you're taking them as a dependent, yes, you can claim it. If you're not taking them as a dependent, then no, you cannot.
The next one is, can the price of books be deducted under tuition and fees?
Yes, it actually can. One of the things you're going to get your 1098T, and you need to be able to supplement what additional money that you put into school, but you have to make sure that that is school related. So, for example, if you're buying your child a computer for school, that computer could be deducted if they're taking it with them to school and they're using it for school. Even if they're playing games on it, it's still considered for their school. Books, same thing. But if you're buying them a Kindle and they're reading all kinds of stuff on the Kindle, it could come back from the IRS that it's not deductible.
Another question. The IRS allows for per diem expenses. How is this accounted for on the return? And then if an employee paid, can this be deducted on the return?
So you're going back into the employer-employee situation. So you're going back into the miscellaneous expenses. You're going to want to fill out the form escapes, and I think it's a 2102 or 2100. You're going to want to fill out that form to say what you've put into it, what the employer has put into it. Per diem being your mileage. So you're going to want to look at your mileage. Those take a little bit more of a step towards more complicated. Again, with mileage, you want to make sure that you're tracking everything, because a red flag, red flag, red flag, red flag. Unless you're an outside salesperson, you need to be able to explain why you're using your vehicle. And if you're doing that, you also need to be able to explain not only just why you're using your vehicle and what you're doing, but you want to be able to explain how that's benefiting your employer.
And that seems to be it online.
All right, great. Well, thank you very much, everybody. I hope I answered your questions. My email's there if you have questions, more questions, or I can help you out. And thank you for listening to our innovation session.